I want you to picture two people sitting at the same coffee shop on a Tuesday morning. The first person has a brokerage account with 11 different apps on their phone. They own shares in 47 individual stocks, 3 crypto wallets, 2 mutual funds, a handful of options contracts they don't fully understand, and a gold ETF someone on YouTube told them was essential. They check their portfolio 14 times a day. They read market news at breakfast, listen to investing podcasts during lunch, and fall asleep watching earnings reports. They've been doing this for 8 years. Their net return after fees, bad timing, and panic sells? About 4% annually. They would have done better leaving their money in a basic savings account. The second person has one brokerage account, one fund. They check it twice a year, once in June, once in December. They spend maybe 15 minutes total per month thinking about investing. They've been doing this for 8 years too. Their annualized return, just over 10%. They outperformed 80% of professional fund managers and 95% of active retail investors, all while barely paying attention. Same coffee shop, same economy, same stock market available to both. The person who did almost nothing crushed the person who did everything. This isn't a story about luck. It's a story about the hidden relationship between complexity and returns that most investors never grasp. The first person isn't stupid. They're informed, engaged, and genuinely trying. They just gradually built an investment approach that requires constant attention, generates constant anxiety, and produces almost nothing in return. The second person discovered something that changed everything. They learned that investing less, fewer decisions, fewer assets, fewer moves, doesn't mean earning less. It means earning deliberately. And deliberate investing creates returns that most active investors never experience. Today, I'm going to walk you through the minimalist investing rules that separate people who actually grow wealth from people who just stay busy pretending to. These aren't about ignoring your money. They're about understanding that every additional layer of complexity you add to your portfolio has a cost you've probably never calculated. Rule 1. Own fewer things, but own them completely. The average retail investor holds positions in 15 to 30 different securities. They couldn't explain the investment thesis for half of them. They bought some on tips, others on headlines, a few because the chart looked interesting at the time. This isn't diversification. It's confusion dressed up as strategy. Minimalist investors hold a radically small number of positions, often just 2 or 3 total funds. A broad market index fund, perhaps an international fund, perhaps a bond allocation. That's it. No stock picking, no sector bets, no crypto speculation, no complicated option strategies. This sounds boring because it is boring. It also works. Research consistently shows that portfolios with fewer holdings, when those holdings are broad index funds, outperform complex portfolios over virtually every long time period measured. Each additional position you add is another thing to monitor, another thing to second guess, another thing generating fees, and another opportunity to make an emotional decision at the worst possible time. Rule 2. Automate everything so decisions disappear. The most dangerous thing in investing is you, your emotions, your reactions, your certainty that this time is different. Every decision point is an opportunity to make a mistake. Minimalist investors eliminate decision points entirely. They set up automatic contributions that happen on payday. The money moves before they see it, before they can feel the market's mood, before some headline makes them hesitate. The amount never changes based on whether the market went up or down last week. This removes the single most destructive behavior in personal investing: timing. Studies show the average investor earns 2 to 4 percentage points less than the funds they invest in, purely because they buy after things go up and sell after things go down. Automating removes the human from the equation. The money flows in during crashes and booms alike. Over decades, this mechanical consistency beats almost every sophisticated strategy ever devised. Rule 3. Measure your return after fees, not before. A fund returning 12% with 1.5% in annual fees nets you 10.5%. A fund returning 10% with 0.03% in fees nets you 9.97%. The worst fund actually puts more money in your pocket. Over 30 years, the difference between a 1.5% fee and a 0.03% fee on a $500 monthly investment is roughly $200,000. That's not a rounding error. That's a house. Minimalist investors are obsessive about fees precisely because they're obsessive about simplicity. Complexity costs money. Every actively managed fund charges for the analysts, the research, the trading, the overhead of trying to beat the market. Index funds charge almost nothing because they don't try to beat anything. They just own everything. The irony is brutal. You pay more for active management and you get less in return. You pay almost nothing for passive indexing and you get more. The expensive product is worse. This is one of the few areas in life where paying less literally gets you a better outcome. Rule 4. Never check your portfolio during a crisis. When markets crash, the financial media becomes a siren. Red numbers everywhere. Breaking news banners. Experts predicting further collapse. Every instinct screams to do something. Sell, hedge, move to cash, protect what's left. Minimalist investors do nothing. Not because they don't care, because they calculated their response in advance. They decided before the crisis what they would do during the crisis. And that decision was continue contributing, continue holding, continue ignoring the noise. The data overwhelmingly supports this. Every major market crash in history has been followed by recovery and eventual new highs. The investors who lost money permanently are almost exclusively the ones who sold during the decline. The ones who held, who did literally nothing, came out ahead every single time. Doing nothing during chaos isn't passive. It's the hardest, most disciplined action in all of investing. It requires having already decided that short-term losses are the price of long-term gains. Minimalists make that decision once, in advance, and then never revisit it. Rule 5. Define your enough number, then invest toward it. Most people invest without a target. They contribute vaguely, hoping the number gets big enough someday. But big enough for what? Without a specific destination, there's no way to build a route. Minimalist investors calculate their enough number early. They determine what annual spending would make them comfortable. They multiply by 25. That's their target. If $50,000 per year represents a satisfying life, the number is $1,250,000. Every dollar invested is measured against that specific destination. This transforms investing from an abstract anxiety into a concrete project with a finish line. You can track progress, you can calculate arrival dates, you can adjust your savings rate with precision rather than guessing. And here's what nobody talks about. The minimalist who defined enough at a modest level reaches financial freedom years, sometimes decades, before the high earner who never defined it at all. Because the target isn't just about how much you invest, it's about how much you need. The person who needs $50,000 per year reaches freedom at $1.25 million. The person who needs $150,000 per year doesn't reach it until $3.75 million. The minimalist lifestyle doesn't just free up money to invest, it shrinks the finish line itself. Those two people in the coffee shop, the one checking their portfolio 14 times a day, is performing a ritual that feels like investing but produces almost nothing. The one who checks twice a year built a system that works precisely because they stopped interfering with it. The greatest edge in investing isn't information, intelligence, or timing. It's the discipline to keep things simple and the patience to let simplicity compound. That's free, and it outperforms almost everything money can buy.